Welcome to The Debate. So, looking at 2026, we have 5 companies, Amazon, Alphabet, Microsoft, Meta, and Oracle, and they are gearing up to spend roughly $690 billion collectively on computer chips and data centers.
Which is just a staggering amount of money.
It really is. I mean, to put that into perspective, that is more than the entire gross domestic product of many developed nations. And it's all being poured into physical hardware that will likely be, completely obsolete in about 3 years.
Yeah, it's a capital sprint unlike literally anything we have ever seen in the history of public markets.
Exactly. And so the fundamental question we are asking today, drawing on recent reports from the Futurum Group, CoBank's infrastructure analyses, BitMEX's deep dive into the SpaceX IPO, and various macroeconomic evaluations of the AI supply chain, is this. Are we witnessing the foundational build-out of a massive generation-defining productivity boom, or is this a highly leveraged, systemic financial bubble that is just destined to burst?
Right, and that is the defining question of the year.
It is, and I look at this unprecedented capital expenditure and I see a rational, fundamentally sound investment. It's being driven by explosive demand for enterprise tokens and real, tangible productivity gains.
And, well, looking at that exact same data, my immediate thought is that we are building the biggest financial hazard in modern history. This entire build-out is being fueled by circular debt, incredibly rapid hardware depreciation, and a really destructive siphoning of traditional enterprise software budgets.
Well, let's get right into the mechanics of why this $690 billion is actually being spent. To me, this is not a bubble. It is a highly rational allocation of capital because of a fundamental shift in the technology itself.
Okay, walk me through that.
Sure, so we are officially moving away from basic chatbots and entering the era of agentic AI and digital labor. And to understand why that requires so much infrastructure, you really have to look at what's happening with token economics. We are basically witnessing a classic elasticity paradox.
You should probably break that down for the listener. Because, when people hear prices are dropping, they usually assume that overall spending goes down too.
Right. Yeah, that is the paradox. So for anyone unfamiliar, a token is essentially a fragment of a word that an AI model processes. Back in 2022, the cost to produce 1 million output tokens was around $12.50.
Which was incredibly expensive at scale.
Exactly. But today that cost has plummeted to under 40 cents. But because it has become so unbelievably cheap, developers aren't just, saving money and going home. They are building systems that consume exponentially more of it. The total volume is just exploding, and this ties directly back to agentic AI.
Because, agents don't just answer a prompt once.
Right. Think about a standard chatbot from a couple of years ago. You ask it a question, it types an answer. That is one single token transaction. An agentic AI operates entirely differently.
It's iterative.
Exactly. It's highly iterative. You ask an agent to, say, build a functional website. It doesn't just spit out some code. It writes the code, it sets up a test environment, tests the code, realizes it made an error, writes a fix, tests it again, and it might loop through that internal conversation 50 times in the background before it ever actually shows you a final result.
Yeah.
So that internal autonomous looping means agents generate like 10 to 100 times more tokens per query than a traditional prompt.
Look, I don't disagree that volume is going up. That's obvious.
And it is so high that the market is completely supply constrained. I mean, Microsoft currently has an $80 billion unfulfilled Azure backlog. They literally cannot secure enough power from the grid to turn on the servers. Their customers are practically begging to rent.
But that's...
Let me just add, if you compare this to the dot-com bubble in 2000, telecom companies laid thousands of miles of dark fiber cables that just sat unused in the ground for a decade. There is no dark fiber here. Every ounce of compute is being monetized the exact second it comes online.
Okay, but I look at the exact same supply constraints and I come at it from a completely different angle. The sheer capital intensity required to build that supply is mathematically dangerous.
Dangerous how?
We are watching the total collapse of free cash flow among the most profitable companies in human history. Free cash flow is Essentially, the money a company has left over after paying for its operations and its capital expenditures. It's the actual cash that proves a business model is sustainable.
Sure.
So look at Amazon. Their free cash flow is projected to drop 320% to negative $17 billion this year. Alphabet's is projected to drop by nearly 89%.
But they're investing that cash into the future of their infrastructure. It's a strategic move.
But look at what they are actually buying with it. They are buying physical hardware. Specifically, they are buying GPUs that depreciate into functional obsolescence in 2 to 5 years. This isn't like pouring a concrete dam or laying a railroad track that lasts for a century.
I mean, hardware upgrades are just a reality of the tech sector.
Not at this scale. If you are Amazon or Alphabet, you are on a perpetual cash incinerating reinvestment treadmill. If you have to replace your entire core infrastructure every 36 months just to maintain competitive parity, your underlying return on invested capital just gets destroyed.
I think you have to look past the hyperscalers' raw spending and look directly at who is renting that hardware from them.
The frontier labs.
Right. Because if you want to understand why Amazon and Microsoft are incinerating that cash, as you put it, you have to look at the unprecedented revenue scaling of those frontier AI labs. Anthropic, for example, they just became the fastest growing enterprise software firm in history.
Oh, I know the numbers.
They jumped from a $9 billion revenue run rate at the end of 2025 to $47 billion by May of 2026.
That top line number is staggering, yes.
It is completely unheard of. And meanwhile, OpenAI is sitting at a $25 billion run rate. When you have customers, these frontier labs, generating tens of billions of dollars in recurring revenue practically overnight, it entirely justifies the hyperscalers spending massive amounts of capital to build the data centers to support them. The demand is proven by the revenue.
I'm sorry, but I just don't buy that. Let me tell you why.
Okay.
I think that top-line revenue is a complete mirage. It is masking extreme structural unprofitability at those very same labs. Yes, Anthropic is pulling in a $47 billion run rate, but do you know what it actually costs them to make that money?
Startups burn cash. We know this.
They are burning $6 billion annually in pure losses to achieve it. OpenAI is projected to lose $14 billion in 2026 alone. You simply cannot look at revenue in a vacuum when the cost of goods sold, meaning the compute required for training and inference, vastly exceeds the cash actually coming in the door.
But startups run at a loss to capture market share. That isn't a new phenomenon.
But the mechanism of this loss is what's alarming. What is actually happening is a closed loop of cash incineration. These frontier labs are effectively being subsidized by the exact same hyperscalers we were just talking about.
You talking about the investment partnerships?
Exactly. Microsoft and Amazon invest billions of dollars into OpenAI and Anthropic. Then OpenAI and Anthropic take that exact same money and hand it right back to Microsoft and Amazon to pay for server time. That isn't a sustainable business model. It is circular accounting. The hyperscalers are essentially buying their own revenue using the labs as a pass-through vehicle.
I'm not convinced by that line of reasoning because you are treating the entire AI ecosystem as a monolith of unprofitability. The broader data simply doesn't support that.
Really?
Let's look at Databricks and Cerebras as prime counter-evidence. Databricks reached a $6.9 billion run rate this year, and crucially, they did it with positive free cash flow. They actually have positive unit economics.
Sure, Databricks is doing well.
And Cerebras, which just went public with a $56.4 billion valuation, they swung to a $237.8 million net income. So profitability in AI is entirely possible.
But those aren't the frontier labs building the massive foundation models.
True, but they prove the ecosystem generates real, sustainable cash. To understand the burn rate of the frontier labs like OpenAI and Anthropic, you really have to look at it like building the first transcontinental railroads.
Okay, the railroad analogy.
It fits perfectly. It requires massive upfront cash incineration. You have to blast through mountains, lay miles of steel, and build the stations. But you don't judge the railroad's ultimate profitability by the cost of laying the first 1,000 miles of track while the trains are just starting to run. The capital expenditure has to precede the operational leverage.
You know, you are absolutely right about the transcontinental railroads. They are actually the perfect analogy. But I think you are skipping over the most important part of that history.
Which is?
Yes, the railroads transformed the American economy. The productivity boom was incredibly real, but almost every single one of the original companies that laid those tracks went bankrupt doing it. The investors got wiped out. A technology changing the world does not protect the people building it from a financial bubble bursting.
Well, that is fair.
And if we follow the money from those frontier of labs back to its source, we find where the macroeconomic damage is happening today. That revenue paying for the train tickets, where is it coming from? It is coming directly out of enterprise IT budgets. And the AI boom is actively cannibalizing the rest of the tech sector to feed itself.
Oh, you're talking about the SaaS deceleration?
Exactly. If you work in IT right now, you are seeing this firsthand. Chief information officers aren't just magically discovering new pools of money in their budgets. 75% of all new hyperscaler and AI spending is being violently redirected away from traditional software.
It's a reallocation, sure.
It's a hollowing out. Because of this massive budget siphoning, median software as a service growth has plummeted to 12.2%.
But that's...
Let me give you the best example of this. Palantir. By all traditional metrics, Palantir just had a spectacular quarter. They posted 85% Q1 revenue growth and a massive 46% GAAP operating margin. That is a dream quarter for a software company.
Yeah, their numbers were solid.
Yet their stock dropped merely 35% from its peak in November 2025. Why? Because the market realized they were trading at a 114x forward price to earnings ratio. When you are priced for absolute perfection, there is zero room for AI budget displacement. The market is waking up to the fact that AI is hollowing out the traditional software ecosystem.
See, I look at that exact same dynamic, but I frame it completely differently. What you are calling budget destruction, I look at as a massive labor productivity upgrade.
How is destroying software revenue a productivity upgrade?
Because companies are shifting from buying static software seats to buying digital labor. Think about what traditional software actually is. An enterprise pays $50 a month for a dashboard, right? But they still have to pay a human employee $80,000 a year to sit at a desk and click the buttons on that dashboard.
Okay.
What AI agents offer is the automation of the clicking itself, and the productivity returns on that digital labor are tangible and they are proven internally.
Do we have hard numbers on that yet? I mean, beyond just the hype?
We do, actually. Look at what the hyperscalers are achieving with their own internal tools. Meta deployed its Andromeda system and drove a 22% increase in return on ad spend.
22%?
Yeah. And Amazon used predictive AI models and warehouse robotics to reduce their logistics costs and cut package travel distances by 12%. 12% for a logistics network the size of Amazon's is literally billions of dollars.
Wow, okay, that is significant.
So when a CIO takes money away from traditional SaaS and gives it to Anthropic, they aren't destroying value, they're reallocating capital to systems that do the work autonomously. That is a massive deflationary productivity shock that benefits the broader economy, even if it happens to hurt legacy software vendors whose products just became obsolete.
Look, I understand the productivity argument. I really do. If an agent can do the work of 3 junior analysts, of course the company's going to buy the agent. But my concern is how this transition to digital labor is being financed on the back end.
The debt?
Yes, which brings us to the most alarming part of this 2026 supercycle, the systemic hidden debt accumulating in the supply chain. We are looking at a highly leveraged circular financial market that is dangerously fragile.
You're looking at Oracle here?
Oracle is the absolute canary in the coal mine. Oracle exploded its capital expenditures to $21.25 billion this year. But to do that, they took on $129.5 billion in debt and another $286 billion in leases.
That is, admittedly, a staggering amount of leverage.
It is. And what is underpinning that leverage? Why do the credit markets even allow it? Because it is all built on the hope that OpenAI will pay Oracle $30 billion a year by 2027 for compute. Oracle is literally betting its entire balance sheet on the solvency of a startup that is projected to lose $14 billion this year.
It's aggressive.
If OpenAI sneezes, Oracle catches pneumonia.
Oracle is certainly making an aggressive, perhaps overly concentrated strategic bet. But one company's leverage doesn't mean the whole market is a house of cards.
But it extends well beyond Oracle. The contagion is everywhere. Look at the recent SpaceX IPO, targeting a $1.75 trillion valuation.
The space and AI play.
Right, and that valuation is built on narrative-driven absurdity. SpaceX's core business is being dragged down by a $4.28 billion Q1 net loss that is almost entirely driven by their merger with xAI. And how is xAI supposed to generate value to justify this? It is being propped up by a revocable $1.25 billion per month contract with Anthropic to use the Colossus data center. Do you see the chain? It is debt built on contracts built on startup valuations.
I see the risk, but the public markets are already pricing this in.
Are they? The public markets are terrified. Look at TSMC, the company that actually manufactures these chips. They just raised their CapEx forecast to $60 to $64 billion this month. A year ago, the market would have cheered that as proof of infinite demand.
Right, it would have been a massive rally.
Instead, the market panicked. TSMC's stock dropped 4% and dragged the entire NASDAQ down 1.4% with it. Investors are finally waking up to the reality that this circular leverage is a bubble and the music is slowing down.
I want to push back on your interpretation of that TSMC drop, because I honestly think it proves my point rather than yours.
Really? How so?
Yes, there is debt in the system, but the smartest players are navigating the capital intensity incredibly successfully without taking on that risk.
Who is avoiding the CapEx treadmill?
Apple. Apple is the prime counterexample to literally everything you just described.
Okay, let's hear it.
They entirely sidestepped the CapEx bubble by outsourcing the heavy lifting of frontier compute to OpenAI and Google. By doing so, Apple maintained a minimalist $12.7 billion in capital expenditures while actually expanding their gross margins to 49.3%. They proved that you do not have to leverage your balance sheet to oblivion to win in the AI cycle. You can integrate the intelligence without owning the depreciating hardware.
But someone still has to own the hardware. Apple is just shifting the financial risk onto Google and OpenAI.
True, but let's go back to why the market reacted poorly to TSMC raising its CapEx. I do not read that as a fundamental rejection of the AI economic thesis. What we are seeing is short-term volatility in a market that is suddenly grappling with harsh physical realities.
Physical realities?
Yes, the reason investors got jittery wasn't because they think AI is a fad. It's because there is a severe structural shortage of high bandwidth memory, or HBM. You can have the fastest processor in the world, but if it cannot pull data from memory fast enough, the chip is useless.
Right, the memory bottleneck.
And the industry cannot produce HBM fast enough. Furthermore, we are hitting literal gigawatt power limits at data centers. You can't just plug these facilities into a standard municipal grid. They require dedicated power plants. The binding constraints right now are physics and supply chains, not a lack of demand or a collapse of the underlying economic value.
But those physical constraints are exactly what trigger the financial collapse in a highly leveraged environment.
How so?
This is multiple compression in action. Think about it mechanically. If Oracle has debt obligations today, but their new data center cannot get a grid interconnection for 3 years, the debt still needs to be serviced every single month. The depreciation on the GPUs still ticks down every single day, whether they are turned on or not.
Well, the carrying costs are high, certainly.
They're fatal. If you have a 2 to 5 year lifespan on a piece of hardware, and it takes 2 years just to secure the power to run it at full capacity, your unit economics are completely destroyed before you even process your first token.
If everything gets delayed, yes.
The financial contagion risk here is that one missed payment or one valuation down round from a frontier lab breaks that circular chain. If OpenAI cannot pay Oracle because their GPUs are sitting idle waiting for power, Oracle's debt becomes toxic. That hits the regional banks, that hits the private credit markets, and suddenly the bubble bursts.
But your entire doomsday scenario assumes that the revenue engine of the frontier labs stalls out. And that brings us right back to the token elasticity we discussed at the very beginning of the debate. As inference costs continue to plummet, the friction to deploy these agentic workflows drops to near zero.
Assuming they have the power to run them.
assuming they get the power, yes. But we aren't just talking about a novelty chatbot anymore. We are talking about AI agents acting as autonomous digital workers integrated into the daily operations of the Global 5,000.
Right.
Databricks generating positive free cash flow at a $6.9 billion run rate proves that enterprises are successfully moving these models out of the experimental phase into production. The productivity gains, like Amazon's 12% logistics cost reduction, are hard, undeniable facts sitting on a balance sheet today. That is why I maintain that this $690 billion infrastructure sprint is fundamentally sound. It is backed by an undeniable paradigm shift toward agentic digital labor, tangible revenue scaling, and massive token consumption.
And my summary position remains that the sheer velocity of this capital deployment is ignoring historical economic gravity. Extreme capital intensity combined with rapidly depreciating hardware creates an incredibly unforgiving environment.
Unforgiving? Sure.
When you have these circular debt obligations like Oracle relying on OpenAI's solvency, or SpaceX subsidizing xAI's massive burn rate with a revocable Anthropic contract, you create a deeply fragile ecosystem. This market is highly vulnerable to systemic multiple compression and financial contagion. The moment the enterprise budget siphoning hits a ceiling or a power grid delays a deployment, the entire house of cards built on forward revenue projections is at extreme risk.
Well, while we clearly disagree on the financial sustainability of the current capital cycle and the risk of this debt, I think we have reached a vital point of convergence today. Looking at all the reports, both of us agree that the ultimate binding constraints on this supercycle aren't going to be software algorithms. The constraints are entirely physical.
Exactly. You can optimize software to be incredibly efficient, but you simply cannot software engineer your way out of a gigawatt power deficit. You cannot code around a TSCMC advanced packaging bottleneck or a shortage of high bandwidth memory. Ultimately, the physical world bats last.
It always does, and it is the power grids, the interconnection backlogs, and the semiconductor supply chains, specifically how export controls might restrict the flow of these physical goods, that will dictate reality as we move into 2027.
There's definitely so much more to explore regarding how these physical bottlenecks will shape the global economy over the next 12 months.
Absolutely. We will leave it to the listener to weigh the evidence and form their own conclusion. When you look out at the fog of this $690 billion build-out, are we laying the foundation of a digital industrial revolution, or are we just pouring billions of dollars of concrete into the abyss? Thank you for joining us on The Debate.